So it's astounding to me how much money has accumulated within pension plans, 401k plans, etc. And most people have the ideology that we're not going to touch this money until the time that we're obligated to, which is age 70 and a half, when RMDs are involved, required minimum distribution. Now, why is this, I've always wondered? Well, it comes back to, as we've said in earlier segments, the taxes that are going to be due. People don't want to pay the taxes. Well, I'm going to share with you a story of a client of mine that just was blown away by realizing what could be done by starting to pay taxes, and more than they thought they were going to pay. This gentleman had come to one of our seminars and had approximately $4 million in his retirement account. He was a physician. He was worth approximately $10 million, and he was 69 and a half or 70, and his wife was 64 at the time. He said, they never made big money. He made roughly $100,000 a year, but they weren't spenders. And after I told him, hey, start spending your money, and his wife, a lovely woman who started nudging him like this, saying, yeah, honey, listen to Howard, let's start spending money. He says, Howard, we're just not that type. We just don't spend. So therefore, I try to pay as little tax as possible. I'm not obligated to take my money out of the pension yet, and we have enough income from other sources to maintain our lifestyle. I said, so you're basically saying to me, other than over the next year, you're obligated to start distributing. If there was a way you could make a deal with the government where you didn't have to distribute, you would like that. He said, oh, absolutely. Why, wouldn't everybody? I said, well, let's analyze it. How is that money invested? And he says, all in bonds. We're making 6% a year. I said, okay, that's $240,000 a year that you just allow to accumulate. Correct. And I say, what do you do with that money? Oh, we buy more bonds. But you don't need the money from the bonds. No, we don't. But we like bonds. And I have to put the money somewhere, and I don't want to pay tax. It's in my retirement account. Okay. So let's assume, again, you don't have to distribute. At 6%, we know your money doubles every 12 years. So in 12 years, your $4 million grows to $8 million. In 24 years, your $8 million grows to $16 million. And he said, Howard, that's about long enough. I mean, I am 70, 69 and a half. My health is not good. My wife is 64. She's in good health, but figure 28 years or so. I said, okay, so 28 years brings her to 92. And by that time, at 6%, it grew again from 4 to 8 to 16. Let's say it grew to $20 million. He says, okay. I said, now you both pass away. You've never paid tax on this money. He says, right. And look at how much we have, $20 million. I said, except for one thing. You see, back in these days, the exemptions were $1 million apiece, and who knows if we're going back to that or not. I said, by the time you're done paying income tax, because you've never paid income tax, and then estate tax, your $20 million will be reduced to approximately $5 to $6 million. He was flabbergasted. I said, congratulations. It took you 28 years to grow your $4 million of retirement money to $5 or $6 million net for the benefit of your family. He said, I never saw it like that. He said, so what's the alternative? What would you recommend? I said, it's very simple. I said, you told me you're making 6%. That's $240,000 a year. Now, within a year, you're subject to your RMDs. You must distribute. And they're not going to start up at that amount of 6%. It'll be much less. But let's not go with the government's table. Let's go with your own. So you're going to take out the 6% you're earning each year. Now, this is also when we talk about, don't worry about the tax. It's a good thing. Watch. $240,000 is what's generated from that $4 million at 6% interest. The $240,000 is taxable. You're left after tax with approximately 150, 160. I can take that money and purchase on your spouse approximately $14 million of insurance at that time. And he says, well, and how long do I have to pay this for? Oh, every year for the rest of your life. Are you kidding me? I have to take $240,000 out to pay $150 or $160 after tax each and every year? He said, do you realize the amount of tax I'm paying is $110,000 a year? We don't even live on that. I said, again, look at what we're going to accomplish. Now that we've taken this money out and we're allocating it to the life insurance that's owned by an irrevocable life insurance trust, so it's outside your estate, the $14 million sits there completely tax-free, income and estate tax-free, ultimately, when it's paid out. You still have your $10 million of assets, taking your income that you live on. You still have your $4 million in your retirement account because theoretically, we've just been taking out the 6% each year. And now, what happens when you pass away? Well, immediately, your family receives $14 million from the income from your retirement account in the irrevocable life insurance trust. That's more than the $10 million that you were worth. Number two, you still have $10 million of assets, right? Your $4 million in your retirement and the $6 million outside. So now what's going to happen? If I leave the remaining $6 million to your children, and assuming we were back in the days of very low exemptions, that $6 million may produce $4 million net for your family, 4.5. Let's add that to the $14 million. That's $18.5 million. I'm going to leave your IRA separately for a minute. You know why? You see, if I were to leave the $4 million also to the children, that might only be worth $1 million or $1.2 million because of income and estate tax. So therefore, what I want to do with that, I want to leave that to charity so you don't pay any tax. So now I've got $18.5 million for your family plus $4 million for charity. That's $22 million. Do you want to take a guess of what you'd have to create from your $4 million IRA so that after all income and estate taxes, it's worth the same $22 million that we created from day one? You're going to have to create in excess of $60 million so that your family nets 18 and your and your charity receives 4. Is there any chance that you're going to create that type of money from your $4 million IRA? He looked at me and said, that's unbelievable. I said, that's the benefit of paying the tax and not worrying about minimize my tax. If I had minimized it and we went with your approach, which is not allowed, by the way, but if it was, of not having to break that IRA or that pension, you would never have created this kind of money. Now again, I showed the extreme on things. You want to take half of that money to create $7 million of insurance for the family? That's fine. But look at the benefit of what was created. And again, it's using monies that you don't need to maintain your lifestyle and monies that you're going to be forced to take and do something with, right? Because remember, at age 70.5, you must distribute. Well, you're not going to spend any more money to live, so therefore you're going to pay income tax and then invest it somewhere. And again, who cares where I put it, as long as I don't need it to maintain my lifestyle, but I'm able to create $14 million on the outside for the benefit of my family and the benefit of my charity. Ladies and gentlemen, that's how we increase the ultimate value of your retirement accounts 10 to 20 times.